Actually, I started by going through what we discussed last week, by looking at the overall perspective of financial management, and 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 when we look at financial management, we look at finance, about personal and corporate, because financial management affect our everyday life. So perspective of financial management include the corporate finance, which is looking at capital budgeting, corporate structure, working capital management, and financial evaluation. The themes is to maximize well, or rather to magnify well, to magnify well rather than maximize profit. Okay, on the personal perspective, finance is about how we relate to the perspective of money in our life. Every person, every one of us are concerned about our financial standing, our financial situation, and we look at finance as an important aspect. Can you see my screen?
Yes, Prof.
Yes.
Yes.
Yes, Prof.
Right, good. Okay,
Yes.
so we want to look at how do we manage our finance, how do we finance our plan, our long-term aspect. For example, we normally we started humbly as an employee, and we will start at a lower salary. We earn something, but not enough to be living comfortably. So we have to start saving here and there, and we at the same time have a vision. We want to own a car, we want to own a house, we want to own all the electrical appliances and so on, and we also think of having some investment. So we need to plan on how to get there. So in the long-term perspective, we may plan to buy a house, but to buy a house today, you need to come up with your 10% deposit for the house. So we need to start saving every month, so that after certain years, 5 years, 6 years, we have enough saving to pay for our 10% deposit on the purchase of a house. And we must earn enough income every month so that we can continue with the installment on the house. We are not on a pension scheme, but we want to retire quite comfortably. So we need to create our pension scheme by creating a target saving. After working for 40 years, for example, we must have a certain target investment that if it will continue after retirement, it could generate some sufficient income that we could regard as a form of our pension every month. And we may aspire to go for Hajj, we may aspire to go for a lifetime holiday in US or Europe, and so we need to have some saving, and we need to start a saving plan. Here is the formula that we can use to work on that. The first formula is looking at the target investment, how much you can expect to accumulate after certain years. For example, if you were to invest certain amount monthly for the next 30, 40 years, for example, and getting a certain rate of return. So here is the formula where A is the target proceed after certain years, PMT is the monthly installment, APR is the rate of return on the investment, N is the number of years of investment. N is the number of um, the frequency of investment every year, and Y is the number of year of investment. We could also rearrange this formula to become the second formula, which is more convenient for us, because the second formula here will determine how much saving that we have to make every month. If we have a target investment of A at the end of Y, which is the year, where APR is the rate of return per annum. So if we put in that figure, for example, here, we target to have 100,000 at the end of, say, 18 years, 100,000 at the end of 18 years. This is for our children's saving plan for him or her to go to university. So we plan to invest for 18 years, and we will invest every month, 12 installment every year. The return is 7% per annum. And so if we put in the figure there and we solve it, we get the figure that if $232. So if we put in $232.17 a month in 18 years, we should have the 100,000 saving. And actually, you only deposited 50,000, and the other 50,000 is actually came from the magic of compounding. So the process of compounding from the investment return will create the impact to you. Right. Now we want to, there will be question in the exam relating to this. Yeah? Actually, someone asked me, when is the assignment going to be there? I overlooked, and I will put in today or tomorrow all the assignment for you to start attempting on that. Okay, today we want to continue this journey in appreciating finance by looking at investment, the investment evaluation. And what is investment evaluation? Is basically is the process of evaluating the viabilities of particular investment opportunities. Because we can be, or you can be evaluating a few investment opportunity at the same time and choose one that will fit you the best. But a lot of the time, we were uh, 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 heavily influenced by someone that maybe offer the investment opportunity to us, and as a result, we do not have the opportunity to really evaluate the investment, and this could end as a disaster. Um, just take an example. An associate has approached you for an offer, an investment opportunity. The initial investment is 50,000, and you are promised a monthly return of um, 5,000 for the next 15 months. Okay, so um, um, you quickly um, calculate the potential return. So it is 5,000 multiplied by 15. So this is 75,000.
Benar. Biasa. Aduh ya Allah. Mak I beli kain lagi. Dia mahal tu lah. Ada kain tu.
Please.
Yes?
Duduk eh.
Right. So it's 75,000.
53 terus. Sayang.
Bungkus. So is this a good investment
Yang beli pack macam nak pack.
opportunity? Essentially, the return is
Ada pun sikap.
75,000 minus 50,000
Banyak orang beli barang. Sumbat di dalam hidup ini. Pakai.
So this is the 25,000 divided by 50,000. Oh, sorry. Where is that? Oh. So this is 50% over 15 months. This sounded like credible, like like an attractive investment. But as an investor, you need to evaluate this. So the investment evaluation need to take into account first the credibility of the fund manager. Is the fund manager that will manage the fund a credible person or institution. This is something that involves some value judgment because we need to evaluate the person, whether we know him well, and we need to evaluate the institution that is using, whether the institution is credible or not. Then we need to look at the risks involved. And what are the risk factors that we need to take into account? This is the risks on the investment principle, whether there is possibility of us losing the money. Then the risk on getting the installment return every month for the next 15 months. Next is the the risk on the guarantee of future return installment. It is the guarantee that we are holding. If the guarantee does not work, of course, the installment also will not come. The overall risk on the environment. Okay, so that's the risk. Next, we need to look at the cost of fund. Cost of fund. Of course, you may say that But this money, 50,000, is my own money, so there's no cost. And in finance, we say that there is no free lunch. There's no free lunch, so everything has a cost. Everything has a cost, and we need to cost this. We need to cost based on the opportunity cost.
Bro, sorry to disturb, because I feel like this is not comfortable to us. Can you get any headset or something? Because I didn't see you booked on the class, and we have some noise, on the background.
Can you see my screen?
Yes, but then we hearing some noise on the background, and I look at yourself, you focusing something else in the middle. Can you get any headset or something?
Access to what?
Headset.
Sorry, I didn't get you.
I type on the chat. Can you get the headset?
Earphone, Prof. If let's say you
Oh,
have an
earphone,
earphone.
earphone.
Yes, yes. If you have an earphone.
So we need to cost based on the opportunity cost of investment. And what is the opportunity cost? And so basically, opportunity cost is the alternative cost of investment. Right. So it is the expected return if we were to invest the same fund in another project. Right. So there are some element of the cost of fund. Number one is the opportunity cost, and number two is the risk. Number three is inflation, because our fund that we are going to invest will be in somebody else's hand, and we have no control over it for the next certain future, and we need to take into account the fact that when we get back this fund, maybe 2 years, 3 years, 5 years in future, the value will not be the same because of the shrinkage in the value of money. So the risk here is the risk of losing money and of not getting back the return. opportunity cost is the alternative cost of investment. And there is another one which is called the the uh, um, um, this is a quite subjective element, but it is the suffering in waiting to have the fund back on our hand to spend. The idea is when we go for an investment, we part ourselves with the money, and the money will be in somebody else's hand, and we will be in agony, waiting and hoping that the money will come back to us as soon as possible. Later on, we will discuss this in relation to the payback period and so on. But for now, we will need to take into account the cost of fund. So how to estimate the cost of fund? We need to be able to quantify this cost. For example, the opportunity cost normally will use the average rate of return in the market. We may not have a perfect knowledge on this, but we just gauge. For example, with the fund that we have, we could be investing in another project somewhere and earn, say, 10% per annum. This may be some discretionary figure, but any figure will be all right. And don't worry of making mistake on this, because later on we will actually calculate what is the actual return of the project, which is the internal rate of return of the project. Yeah? So the risk also another estimate or guesstimate. We estimate based on market rate. How much are people charging for risk? Of course, risk come in different kind. In our case, we need to look at the credibility of the person who managed, credibility of the institution, credibility of the guarantee, and so on. Let's give it, say, 2%. Then we have the inflation rate. This is normally determined by the general inflation rate. We call it the CPI rate. So, for example, in Malaysia now, the CPI rate is about 1.8%. We can put in 2%, for example. Then the suffering, this suffering can be the agony of waiting, the suspense, and also the because postponing expenses, or rather postponing from spending in the future. Let's put in 1%. So we have the total cost of fund. This is 15%. So 15% per annum is the cost of fund. Now, next, what we want to do is to look at the cash flow perspective. Cash flow perspective is essentially the cash inflow and outflow and the timing. So we need to be able to estimate when will we have to pay out and how much, and when will we get back and how much. We may get this back in installment. We may get this back uh, one bullet amount and so on. But we need to know exactly for cash payment and cash receipt, the timing and how much. Then now we need to look at the perspective of the time value of money. What is time value of money? Essentially, the principle that money today is worth more than money in the future. So we need to convert all future money into today's value, and this is called the present value analysis. Okay. Present value analysis. And how do we do this present value analysis? Is by introducing the concept of discount factors, taking into account the time value of money. We normally do this on a yearly basis. Essentially, we recognize that money 1 year from now is worth less than money now. So always now is better than tomorrow. Now let's so how do we uh, uh, calculating the discount factor? We take into account the cost of fund, and we use it to determine the discount factor. This is how we do. For example, discount factor in year one, one factor at the end of year one, is this is calculated using this formula of 1 divided by one plus up to the power of n. And let's this is actually the general formula. So we say that the discount factor is equals to so for year one, the discount factor at the end of year one is equal one divided by one plus. Okay, so we will need to specify the rate if the cost of fund is our cost of fund just now we calculate is 15%. So if the cost of fund is 15% per annum, then this is 0.15. It is 1 divided by 1.15. And that's equals to 1 divided by 1.15 is 0.8696. Okay. So that's for year one, and discount factor at the end of year two this is 1 divided by 1 plus 0.15, 1 plus 0.15. So this is for year 2. This is 1. One point 1.15 multiplied by 1.15. So that's 1.3225. 1 divided by 1.3225. This is 0.7561. Okay, so the same thing for year 3.
So,
Yes.
I think you mean the 1 plus 0.15 to the power of 2. I think the equations of the equal should be plus.
The power of n is missing.
Correct now?
Yes, yes, yes. Thank
Yeah.
you.
Okay. Right. Thank you. So this is basically we can after this actually model this in our Excel or spreadsheet so that we have this general formula and then we just have to change the rate every time we do the analysis, so that we don't have to recalculate every time that we want to use. Yeah, and that is normally what I did in my analysis when I do this. So essentially, this is 1 over 1.15 multiplied by 1.15 multiplied by 1.15, which is 1.5208, and that becomes
09, is it?
09. Yeah, 09. Good, thank you. And so
Sorry, Professor.
yes.
Can I just check? The original formula discount factor has a power to n, but I don't see the power to n in your calculation.
Basically, the n here means the number of year.
Yes, yes.
Okay, all right. Noted, noted.
So for first year here,
Okay,
this is actually 1,
all right. Thank you.
and this one is 2, so that we just expand it.
Makin suaka pejabat. Makin cahaya gitu.
So it's 1 divided by 1.5209. So it is here 0.6575. Okay, just look at the figure here. What it means actually is that after 1 year, one ringgit is only worth 86 cents. After 2 years, RM1 is only worth 75 cents. After 1 year, after 3 years, the ringgit is only RM1 is only worth 65 cents. So the value of ringgit decline, and this is the present value. This is the present value. Now we will apply the present value, the discount factor on the future cash flow. So, for
Prof,
example, yes,
can I ask, this
yes.
discount factor, right? Can we consider this as an inflation rate or is different from inflation rate?
But well, inflation is one part of it, just one part of it. There
I
is more than inflation. Just like we see just now, what determine this factor is number one, the opportunity cost. Number two, the risk. Number three, the inflation. The inflation is only 2%, but here we are taking into account 15%.
I see.
So inflation is part of it.
Okay, got it. Thank you, Prof.
Okay. Now we'll apply this. So, for example, the cash inflow at the end of year one, cash inflow at the end of year two, and so on. So let's say just now we expect to receive we expect to receive 5,000 multiplied by 12, 60,000 in year one. $60,000 in year one. Let's say the other 30,000 is in year two. It may
15,000 in year two.
How much?
1,550 in year two. Only 3 payment in year two.
Okay. In year, just now in year one, we will receive sorry, yeah,
10,000 times
we
12.
receive 60,000, so 15,000 in year two. 15,000. So we will now calculate the present value of future cash inflow. So the future cash inflow is so we will say end of year one is 60,000 multiplied by 0. We take the discount factor for year one, 8,696. And actually, though we will be receiving in the middle of year two, or rather in the after 15 months, but that is already in year two, we can safely say that it is received in year two, so it is 0.7561. We do not have a present value for monthly present value, though we can do if we like. Essentially, if we want to do a monthly present value analysis, we need to divide the 15% by 12, and then we will calculate what is the discount rate every month. We can do, but this is seldom do. Normally, unless the project is involves a big amount of money that come every month, then we may do that. Otherwise, we will normally do it on a yearly basis.
Prof, normally we are using four decimal place, is it? Just want to confirm.
Yes. Four
Okay.
decimal place, yeah. And this is also used in, later on I want to show you the present value table, which is the alternative way of searching for this discount rate. Instead of calculating ourselves, we could actually rely on the present value table. Shortly, so it is 15,000 multiplied by 0.7561, so that's 11,341.50. So when we total, we say that the total present value is 52,176 plus 11,341.5. So that's 63,517.50. Okay, so that's the present value. Then we will calculate what is the net present value. The net present value is essentially the total present value is this figure, and we will less the initial investment. Okay, so this is 50,000. So we say our net present value is 13,517.50. Okay. So what is our conclusion? We say that this investment is viable as it generates a net present value of 13,517.50 after discounting the future cash flow at 15% per annum. So what it means is that this project is giving a return of higher than 15% per annum. And how much higher? Higher by 13,000. Okay, so this is a simple analysis. Let's try and and repeat this in an Excel. So if we have an Excel, so this is an Excel, and we want to do an investment analysis. Let's say you are going to venture into you venturing into this project of
Prof, sorry, boleh tanya? Okay, N tu, it must be in years. Can it be in months?
Come again.
N, the N.
N.
N tu, it must be in years. Can it be in months?
Yeah, that's right. I was telling you just now. It is normally in year, but if you want to do it in month, it's okay. But you need to divide the cost of capital too by 12 lah. Then you get instead of 15%, so you'll get 1 point berapa tu? 15% divided by 12, so you get 1.25% per month. It can be done.
Understood. Thank you.
Right.
Prof,
Yes.
question, for N to right. So let's say the N, let's say we want to calculate for 5 years.
Yes.
So we need to have 5 different number of the discount factor lah, right? Correct?
That's right.
Okay, understand.
All right. Okay. Now, let me tell you the shortcut. Right now, we assume that we have to calculate every month, which is good. We need to, if we calculate this, we can get our discount factor every month conveniently without relying on anybody else. But we can also go on Google. If you go to Google and you type the present value table, and it will give you a present value table like this. Okay, so this is the table that give you. I have problem in trying to download this. Tak tahu macam mana nak download this. Present value table, download. Tengok boleh tak? Yes. Okay, now you can see it bigger kan? So you see on top here is the rate. This is the discount rate, 1% to 15%. Then the row here is the year, up to 30 years. And that number two is the number that we calculated just now. For example, we were calculating at 15%. 15%. Year one is 0.8696. Year two is 0.7561. So we can check our calculation is quite accurate. Yeah? So we can use this this table conveniently to get whichever rate that you want. If you just want a rate for a particular year in year 10, then you just take year 10. Year 10 at 15% is 0.2472. 0.2472, that means at 10% cost of capital, sorry, at 15% cost of capital, $1 is only worth 24 cents after 10 years. Yeah, so that's the present value table. Right.
Prof.
Yes.
Just want to double check. This the right top there is stated is PB. PB means present value. However, just
Yes.
now in the words file, the formula as stated is so-called discount factor for the formula.
Yeah, discount factor is another name for it. But
okay.
actually, the present value is when you multiply this figure with the amount. This is just a factor, but you need to multiply by the ringgit or dollar, then you get the present value. This is assuming that the ringgit is 1 ringgit.
Oh, okay.
All right. Okay, now there is another table. This is present value table. There's another table called the cumulative present value table. Cumulative. And this is the cumulative table. The cumulative table. Nadia, let me try something else. Okay. Tak keluar juga. Nanti. Cumulative. Okay. Right. This is a cumulative table, and the difference between this table and the earlier table is this figure, you see all the value is higher than 1, the factor. And how come? Essentially, this is used if the future cash flow, doesn't matter cash inflow or cash outflow, are the same every year. For example, in our case just now, if the amount has been if the amount is yearly, every year you receive 5,000, 5,000 in year 1, 5,000 in year 2, 5,000 in year 3, 5,000 in year 4, 5,000 in year 5. So every year you receive 5,000, and so you can just, instead of calculating year by year, every year for 5 years, you just take the figure in year 5. So figure in year 5 here is 4.85, and this 4.85 is cumulative for 5 years. So if it is 5,000 a year, you just multiply 4.853 by 5,000, then you get the value of 5,000 every year for 5 years at the present value.
Sorry.
Got it?
Prof, sorry.
Tak dengar lah, bro.
Tak dengar. Okay, speak louder, please.
Prof, can you hear me?
Yes, but very, very soft.
Okay, maybe my myself. Can I type in the chat box?
Okay. I mean, I can hear now, just now. Go ahead.
Prof, let's the 10%. Can we say it is the IRR for the NPV? The percentage.
Di yang mana tu?
The percentage. Can I say it is
This
IRR?
percentage. This is actually the discount, the cost of fund, interest rate.
Okay.
This is cost of fund. Belum sampai lagi IRR. Lepas ni baru kita pergi IRR.
Sir,
Yes.
Can I ask question?
Yes, please.
So, correct me if I'm wrong. So the cost of fund for each individual will be different.
Yes, for each individual project will be different depending on the fund that you get and the risk profile, the inflation rate, and so on. Because if you change the nature of the project, you change the scenario, the location, all will change the cost of fund.
What is the difference between the suffering and also the opportunity cost?
Difference between suffering and
opportunity cost.
Opportunity cost is the alternative investment. For example, you have 50,000 and you can invest with your associate 50,000, but at the same time, you can also invest in EPF. EPF is giving 6% return, or you can invest in unit trust. You can invest in property trust, so that each will give a different rate of return. So that's opportunity cost. But the suffering is your own suffering. I mean, when you invest, you have this suffering every night. Sometimes you cannot sleep or at night because suddenly there is a war and you do not know what is the fate of your investment.
Prof,
So,
for the opportunity cost, should we consider a multiple ventures or we take the highest opportunity cost like macam EPF, ASB, we take the highest one from out of the few, right?
Yes, take the highest.
Thank you.
All right.
Prof,
So now, yes.
For the cumulative present value,
yes.
for this table is only 3 decimal place. Should we get the table for 4 decimal or
don't need. Don't need. Three decimal places also is accepted for cumulative.
Okay. But if let's say it's not, if it's the present one, then we need to get 4
yes.
decimal place.
Basically, that's a common practice. I mean, actually, 3 decimal place is less accurate than 4 decimal place.
Prof, can you explain again what is the application when we want to use the cumulative?
Cumulative,
versus the previous one.
Okay, we start with the present value table. Present value table, we say that, for example, if our cost of fund is 10% and we invest for 10 years. So this, no, this is cumulative. Sorry. Where is the... This is 15%. Kita lihat our investment tadi is ambil 10% lah ya. Kita 10%. 10% is the cost of capital, and we invest for 10 years. 10 years. So this is the discount rate that we will apply every year. Year 1, 9091, year 2, 826. So we multiply all this by the cash inflow that come every year for the next 10 years. Okay, and then we get the present value lah. Okay, that's the present value table.
Okay.
But in the case of cumulative present value, sorry, hilang. Right. Okay. Yeah, cumulative. In the case of cumulative, dia 10 years katalah at 10%. Tapi because every year the cash inflow tu sama every year. Katalah every year 50,000. Every 50,000 daripada year 1 sampai year 10. So instead of calculating one by one every year, we just take the cumulative at the end of year 10.
I see.
6.145 multiplied by 50,000. Then we get total of actually cash inflow for the 10 years at present value.
So that in our example tadi yang based on Prof punya scenario, the reason we use not using this cumulative is because the 15 months punya return.
Yes.
Because first month is first year different, second year is different. Tapi if let's say it's 24 months, then we can use this particular cumulative table lah. Betul.
Right.
Okay, and then is it I assume the amount will be different lah kan?
Yes,
Using
of
cumulative, also yearly yang bukan cumulative, the amount will be different lah, betul tak?
Right.
Factor, right? Okay, understand. Alright.
Okay.
Prof, ada satu soalan Prof.
Yes.
Prof, okay, untuk question ni, katakanlah ini pada awal-awal investment. Katakanlah investment ni kita buat sebelum ambil contoh pandemik hari tu, COVID-19. Then after COVID-19, untuk projek macam 10 years, kita kena recalculate balik sebab ikut cost factor yang baru.
Yes. Kalau if the scenario change and our cost of fund pun berubah, then we have to recalculate. Kalau the cash projection every year pun berubah, we also need to recalculate.
Oh, okay, thank you.
So, based on the 4 factors that you shared just now about the cost of fund, where shall we factor, for example, the management fee, bid offer price differ into those cost of fund? In which factors?
Management. Okay, there is management.
Management fee, trustee fee. Many of the charges.
Okay. All those fee, management fee and trustee fee should be included in expenses. And expenses will be in the cash outflow. Cash outflow, kita akan masukkan amount. But that is if we pay out. If we do not pay out the management, then it becomes what is called as a notion cost. It is not actually paid. So in that case, good point. We need to we can take into account, but separately, because it is not a real cash inflow and cash outflow. In our analysis, we normally just take into account the real cash inflow and cash outflow.
But those fees are also the real cash outflow, right? And
if it is real cash outflow, if it is a real cash outflow, then we will put it as a cash outflow. Yeah.
So it can be categorized into another category.
Yes.
Thank you.
All right. Now back to our spreadsheet. So this is a spreadsheet. Let's say you are venturing into this project, and this project is a special project. You are salvaging a developer who has abandoned his condominium development. So basically, you need to spend, let's say you need to spend 50 million to complete the project. Then you will rent all the there is some 300 condominium. Let me check if this realistic. 50,000, 50 million divided by 300. Yes, it's realistic. Thank you. So it is 300 condominium and expected rental is 1,000 per unit.
So the rent is REND or RENT?
Sorry. This is right.
Means there are 300 unit lah, something
300
like that.
unit. 300 unit, yeah. So then you have the management fee is 100 ringgit per month per unit. Okay, and so this will the project will be completed in 12 months, and then you can start your rental after that. Okay, now we want to know the cash inflow and then the cash outflow. Okay. Now another assumption that you want to make is after 20 years, you will sell all the condominium at 350,000 each for 20 years. So we will have here, let me try to make it bigger. You have a cash inflow in the form of, okay, cash outflow first. Your cash outflow is maybe you need to pay the current developer um, 10 million lump sum. So this is payment to current developer, and then the cost of completing the condo management fee the cash inflow is in the form of monthly rental. The maybe we may have to pay some rates on the properties. So we need to make an assumption on the rates. Rates is at let's say 1,500 per unit per annum. Okay.
What is this rate, Prof?
This is the property rates, like the property tax. Every year, the owner needs to pay property tax, monthly rental, and proceed from sales of properties. Okay, so we put here the year. Here we start with the year 0. Year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Yeah, and this is total. Right. So the year, we can insert last bit. Okay. So we start with the payment first. To developer, we pay 10 million. Then the cost of completing the condominium, let's say we spread this evenly. The 30 million will be spent. This is based on the estimate of the architect and the engineer. Let's say you spend 5 million. 5 million. 3 million.
Prof,
Yes.
is there a reason why it has to be 20 years, or is that the investment year
No,
that
I
we
mean,
want to invest in?
it is just a discretion. I mean, you can sell after 6 years also, but I mean, I am assuming that maybe 20 years is a good time because at that time, 20 years, you need to renovate all the condominium, so you don't want to spend on the renovation, so it is time to dispose. I mean, you can.
Thank you, Prof.
Yeah, you can do the what you call sensitivity analysis later. I will tell you, I'll coach you how to do this. So this is 10, 13, 16, 18, 20,
Sorry,
20.
Prof. Sorry, Prof.
Yes.
How you identify the cost of completing the condominium, the 5 million, 3 million, and 2 million?
This is also, as mentioned earlier, this you need to work with the architect and the engineer, that the civil engineer that work on the finishing, because I assume that this condominium is already 60% maybe completed or 50%, so there is not exact nature of construction work that you need to do. You are just doing the finishing.
Okay, thank you.
Yeah.
Prof, this is
Yes.
you write until 8 and 9 already. This is year or month?
Oh, that's a good point. That's a good point. It's only
Yeah.
1 year.
Yeah, because impossible take 8 years to complete.
Yeah. Okay, so we'll just put in here 1 year. So this is 30 million, 1 year. That's it. And then you have the management fee that will come in the third year. This is the management fee is 1,005. 1,500 multiplied by 300. So it's 450. So it's actually 450 every month, every year. Sorry. Assume you can assume that
Prof, how
it
you get
is
450 already?
increasing,
How you
or
get?
you can sorry.
How do you
This
get
is
450?
wait, it is 1,500. Sorry.
Per month, Prof.
This is management fee, right?
100. It's 100 multiplied by 12 multiplied by 300. So 360.
Yeah.
Okay. Then the rate is 450. Yeah. No. The rate is 450. 1,500 multiplied by 300.
Yeah, it's 450, right?
Yeah. Right. Okay. Now,
Professor.
proceed.
Professor.
Yes.
Yeah, the cost of completing the completing another 20 million, I think you should put in on the zero columns. Total cost will be 50 million, right?
No, because zero column is now. Zero column is now.
The total cost will be
I think
50 million.
Prof means the first year it need 1 year to complete the whole building. So that's why the first year there is not yet complete. The second year now they start to sell and people stay.
Right.
The cost completing the condominium total will be 50 million, right?
Yeah. The
So
30 million.
another 20 million.
Oh no, this is actually not 30 million, 50 million, isn't it? 50 million. Yes. Okay, now the monthly rental will begin in the second year. And the rental is 1,000. So it is 1,000 multiplied by 300. So 300,000. Wow. Cannot be lah.
Prof, kena tak 12 tak? Sebab 1,000 ni is per month kan?
Yeah,
Not
1,000
per year.
multiplied by 12.
Multiplied by 300.
Multiplied by 300. So it's 3,600. Okay, 3.6 million, yeah. You can assume that it can increase also, but I am not taking that we just conservatively say, and then we will sell it at the end of 20 years for 350,000. 350,000 multiplied by 300. So it's 105. Okay. Let me. Right. So now we will calculate the net cash inflow. Ini net cash inflow.
Sorry, sir.
And yes.
Am I right that you're assuming the tenants will be paying the rental at the end of the year after they stay for 1 year?
They pay every month.
But you are factoring the monthly rental income into end of year 2.
Yeah, because in year 1 we are just completing the unit.
Yes, so the year 2, the first 12 months they stay, then only end of the 12th month they pay the 3,000.
No, they pay every month. They pay every month, but they pay for 12 months 3.6 million. But for our purpose, when we discount, we assume that it is actually in the middle of the year, isn't it? Half on average. So we can use the cost of capital later. Kita instead of using the full year punya rate, we can use half year rate. Ataupun conservatively, we say that mana because on average it is mananya half year, so we will just assume that on average it is received at the end of the year lah.
Okay.
I mean, it is, we can make it as accurate as we want, depending on how big is the value or the amount that we are dealing with, because and in this case we are actually the amount is not very big lah. It's about 3.6 million a year, so we can be rather we can refine as we go along if we want to be very accurate. What I want to do is to show a basic analysis and then perform what is called as the sensitivity analysis. And the sensitivity analysis is where we will alter the amount. Ini the silap low. It should be here. It should be here. Monthly rental. Monthly rental, and this is proceed from the sale of properties. So the figure is 105 million. Okay, Now, this is where we want to apply. Now, from the net cash inflow, our net cash inflow here is basically there. Except for year 20. Okay, and then our cash outflow, essentially, this is this is a negative figure. And this is also a negative figure. And this is right. So we have here the.
So the one is net cash outflow, the typing there.
Yeah. This is actually we should put in just total total cash outflow and this is total cash inflow. Then here we have the net cash inflow. And the net cash inflow here is balik semula. Okay, the same here. Right, and here copy. Okay. Now,
Prof.
Yes.
Question on the 20th years in your inflow punya schedule tu kan, why we still have that 3.6 apa sewa, but we also jual dah the unit kan?
Kita akan jual at the end of the year.
Okay, understand. Okay, good.
But actually, we will not include this mana kat sini because why we want to use a different present value. Different present value. Nanti kita, okay, right. Okay, now actually selepas ni kita nak kena introduce the discount factor sini. Discount factor, and the discount factor.
Sir, why did you remove the proceed from the property sales?
Not remove. We will apply later because we want to use the present value table for that. Differently from the rest.
Okay.
I will show you later. So the discount factor for year 0 is 1. Discount factor for year 1. Now we will need to decide on the cost of capital. Sini kita tulis cost of capital. we decide on a cost of capital. What is the cost of capital of our project? And let's say that the cost of capital is say 15%. So we'll put there 0.15, yeah, 0.15, and actually 0.15 is maybe a bit high because this is a long-term project. Let's put in 10% lah, 0.10. 0.10. Actually, this is kalau kita convert jadi 10% lah. Now, so this is for year one. For year one, if you remember just now, the formula is 1 divided by 1 plus apa pula masalahnya?
1, Prof. 1. Bukan exclamation mark.
Okay. Right. So that's the rate. And then this for year 2, kalau kita tengok for year 2 sampai year 20, sampai year 20, the rate is the same. The rate is the amount is the same. The amount is the same. So we can actually use the cumulative. We use the cumulative. Tapi kalau kita tengok the cumulative ni, this is cumulative for 20 years at 10% is 8.514. So 8.514 we need to show calculation 8.514 is for 20 years. Cuma in our case, for year one kat sini tak ada. So for year one kita it's not the same, it's 50 million. So it is from year 2 to year 20. But 8.514 is from year 1 to the year 20. So if we want to use this present value table, you need to take out the year 1. So how do you take out the year 1? Is you minus 0.909. Yeah, from 8.
Why kita tak pakai the 8.365 The 19 years punya rate.
Kalau kita pakai ni, then that's a good point. Boleh juga. Tapi then dia yes. Yes, that's a good idea. So kita pakai 8.365. So basically we will use 8.365. And what we do is we have this figure kat sini multiply by okay. So that's the present value. That's the present value. And then this 105 million, we will take the present value table. Just now kita ada present value table. Yes, this one at 10% for 20 years. So kat sini 0.1486. So is so bila kita multiply ni kita dapat so actually even though we are getting 105 million, it is actually only worth 15 million. Yeah, only worth 15 million at 10 million at 10% cost. So so actually our net present value, our present value is this figure, 38 million.
Sir.
38 million. Yes.
Sorry to interrupt. I think your formula that you suggested just now, we take the year 20 minus the year 1 is more proper because your initial capital happens in the year 0. So end of the year 2 outflow, end of the year 2 inflow, the factor will be different from the year 1 inflow already. So
yeah.
So your suggested to take the cumulative present value of year 20 minus the year 1 is more accurate in this project.
Yes, I reckon that was the way, but since you suggested just now,
Oh,
I
not
felt
me.
Okay, okay. All right.
Also, because we start at 20 years projection, so
Yes, yes.
it's very fair to -1.
Right. Okay. So we'll do that one then. So we will take this is right. So we take 8.514. So 8.514. 8.514 minus minus 0.909. $0.909. So this is the one that we will calculate. Yeah, silap pula. Okay. So basically we take this figure, we multiply by sorry, this is multiply by yeah 21 million plus 15 million is 36 million, and 36 million Then our net present value is the rental present value of rental. Proceed.
Sorry, sir.
Yes.
The factor just now, if we minus 0.909, we are like minusing the future value factor.
Right.
Should we minus 1 minus 0.909, which is more appropriate? The differ of 1 year. The differ of 1 year is not 0.909, right? This 909 is happening in end of the year, a depreciation or the value of the present value, the discounted present value. Sorry. So
yeah.
actual differ is 1 minus 0.909.
No, 0.9090 is the proceed is the proceed for year one if we had received, but we didn't receive.
Yeah, so the difference of the year, beginning of the year and end of the year is 1 minus 0.909, isn't it? So the factor taken into the consideration here is year 20 minus 1 minus 1090.
Essentially, what we want to say is that we are supposed to receive for 20 years, but we only receive for 19 years. So for the first year, because we didn't receive, we have to minus 0.909. That's what we said.
But the difference of the discounted value is 1 minus 0.909, not 0.909.
But if we only take into account the factor, then we assume that we actually received some money in year one, but we didn't receive anything. I don't know whether you agree with me.
Okay, Prof. Agreed.
Okay. So present value of rental proceed, then present value of the sale proceed. Pasal tak ada pula.
So how you get the 36 million already?
How do I get 36 million?
Because you add up the top there.
36 million, yeah. This is basically this figure here, 15 million plus 21 million.
Why we want to add on like that?
Because that is the total present value.
Total present value.
The formula, bro, the total present value plus the year on year.
So this is the total present value. Total present value is this figure plus this figure. Okay. Then we less the investment. And the investment is there's two investment. This is the payment to developer. And cost of completing the condominium. Okay, let me correct that. Okay, so total initial investment $60 million. So the net present value of investment so this project is giving a negative net present value of 23 million. Actually, though if we without calculation of present value analysis, without calculations of present value, we actually receive we actually received 68 million. 68 million. So we received 68 million, but we paid 44 million. How did this come about? It's not right, isn't it? This is not right. Where does the negative figure come? Oh, because we took into account the 16 million. Okay, we can recalculate.
$75 million something.
Right. Now it's correct. 68. And this is what? This one also taking into account that. We don't want to take into account that. Okay. So actually, we received 53 million cash on the rental, and another 105 million. 105 million. So actually, we received 53 million net plus 105 million. So actually we received $158 million, but when we calculate the net present value, it is a negative 23 million. And why is this? Is because of the cost of capital of 10%. What if the cost of capital be reduced to 5%? What if the cost of capital is 5%? Then we will see that actually our present value of rental proceed will be present value of rental proceed is this one. And we will take the rate at 5%. Sorry, at 5%. At 5% is 12.462. Yeah, 12.462. $12.462 multiply 3 minus minus
0.909, Prof.
0.909.
909.
Not 909
No, sorry.
anymore.
It's different table already.
Different table. Is 952, 0.952. Uh, 52. So then this will be 53 million here, multiply by no. Sorry, not that one. It should be this figure, isn't it? 2.9. Right. Hey, mana begini? Multiply by, yes. Yes, 32 million. So it has gone up to 32 million. And then the present value of the sales proceed is this is now we take the 105 million, but we will multiply by at 5%, 20 years is 3769, 0.3769. Zero point 3769. Next up. 0.3769. So this will be right. So total present value $71 less initial investment of 16 million. 16 million, so present value is, so basically we now see that if the cost of funding or the cost of fund is reduced from 10% to 5%, this one is the net present value at the cost of fund of 10%.
Prof, sorry, Prof. I would like to ask about this one.
Yes. Macam mana?
So the net present value is the net profit, isn't it?
The less, come again, the less present value.
Present value is equivalent to net profit, isn't it?
Yes, this net present value is actually net profit. So this
Okay,
net
thank
profit.
you.
Yes, right. Right. Okay, so now we got the result of, if you want, you can work and refine the cash payment, the cash receipt, and as you refine it, you will get a more refined result. But what we want to work now is the next indicator. We want to calculate what is called as the present value index. And what is present value index? Is actually present value index is present value, rather total present value divided by total investment. So in our case, this is the present value is 71 million divided by total investment is 60 million. So the index is this. The index is total present value. So total present value just now was 71 million divided by total initial investment. So 1.19. 1.19 is the index. If we take the first calculation, the index will be negative. The index will be negative. It will become, kalau using the first one, this is at 5% cost of capital. Ini at 10% cost of capital. And this is present value divided by, so at 10%, the present value index is less than 1. Less than 1 means it is not viable lah. Kalau it is more than 1, then it is viable. Next is the internal rate of return, or IRR. IRR is the actual rate of return of the project. The actual. And what is the actual rate of return? Just now, we are using 5%, and it is positive 11 million. But when we are using 10%, it is negative 23 million. So we know that our actual rate of return is in between that. Yeah, in between that. And we can do what is called the iteration method and vary the cost of capital until we get a zero net present value. So when we get the zero and net present value here, then that rate that we are using is IRR. So for now, we can say that the IRR is between 5 to 10%. But we need to calculate this, and this need the iteration process. For example, let's do what if the cost of capital is 8%. Yeah, if it is 8%, then we will see that the present value of rental become kalau 8%, sini so it is 0.08. Sorry. 0.08. So here will be 0.08 multiplied by no, sorry. What am I doing? 0.08 means we need to find what is the rate, the cumulative present value. the cumulative present value. Yes, at 8% is 9.818.
So we don't need to deduct back the first year already.
But we need 9.818 minus 9.818 minus 0.926. Uh, 0.926. So that's the rate. So here is multiply. Okay. I'm sorry that we are using a problem that is quite complicated. I mean, not really complicated. I mean, if you understand the principle, but it is still relatively complicated. And then we take the present value of sales proceed, and the present value of sales proceed is taking now the, I don't know why, what is this happening? Okay, the present value of sales proceed, we want to take into account the present value table at 8% for 20 years. Is 0.2125. So it's 0.2125, and so this is multiplied by the proceed of sale $22 billion. So the total present value $47 million less the initial investment 60 million so the net present value is still negative, 12 million. Tadi 23 million. So now we know that it is lower than 8%, but higher than 5%. So we need to do it again. But actually, this we can do this using the calculation if we for example, because now we are referring to the table. If we calculate it ourselves here, the rate, then we don't have to refer to the table. Then it can be shown just by changing the rate. Anyway,
Prof,
yes, yes,
did you will share this Excel sheet to
yes.
us?
I will say to you now.
All right. Okay, great. Thank you.
Right. Okay. Any more question?
Sir,
Yes.
later when the assignment or final assessment or what will it be so complicated?
Will not be as complicated as this lah. No.
Straightforward question.
Yeah, else I think many people will very headache, right?
Yeah.
And
This
you will
one,
be very headache in marking the paper also.
Yes, Prof.
Yeah.
no, actually this one.
Question. In
Yeah.
any way, we can either, like you said, like we can either calculate manually our
Rate.
the rate, or we can refer to the table online that we can find anywhere.
Right. Yeah. So it is better to calculate your rate. If you calculate it yourself here, you formulate kat sini, then you just have to change the number on the rate. Everything else will follow. So you will not have to do many times. So just now it become complicated because we are referring to the table and then back. Otherwise,
Exactly.
this is actually a simple problem.
Exactly, Prof. Okay. I noted on that. Thank you.
Right. Okay. So I
Prof.
mean this.
I consider here got 3 scenario lah, Prof. Am I right?
Okay.
Three scenario for, I don't know, 10%, 8%, 5%, something like that.
Scenario
Yes.
of COC.
Yes, of COC, yes. So basically we say that at 10% is not viable. At 8% is not viable. At 5% is more than viable.
Prof, based on your experience, Prof, will it be lower than 10%, like for the high investment?
Depend on your cost of fund, actually. What is your cost of fund? But actually, if you work on a development project like this, normally the bank will be giving you a special rate. If the bank give you 6% maybe, will it be viable? And I think it will be viable at 6%. But you can quickly calculate at 6%.
Yep.
Prof,
Yes.
I wanted to ask, right? For example, because under the assumption our monthly rental is 1,000 ringgit per month for 18 years. However,
right.
in terms of like usually the monthly payment sometimes it will increase year by year or 2 years once. Can we, because that is not part of the assumption, but is that also can be considered to be part of the
Yes.
profit?
No, well, if the maintenance cost is less than what you projected, that's additional profit. But if the cost is higher than what you expected, then they will reduce your profit.
All right, thank you, Prof.
All right, that's it for today. So this is the
Prof,
yes.
The recorded video will be available within 3 days, right? How about the last week's video?
The last two, actually the last week one I've given to the cost administrator, and they said they will upload it on what you call it, on YouTube.
Euros.
On YouTube. That's what they say, on YouTube.
Yep.
You can try and find out. But this week, from this week onward, they are organizing it themselves. So it will be on Zoom. I don't know how they're going to distribute it to all of you or to make it accessible to you.
I think it's also in YouTube, Prof. It's the same.
Is it?
Yeah. In
Ah,
Europe,
okay.
they have this Zoom recording. It will be in YouTube.
All right.
Prof, can we excuse because we have another one
Yes,
in
yes.
2:30.
Yes, I mean the lecture is over, so you may leave, and you may and we will meet next week.
Prof,
Thank you, Prof.
saya
Yes.
tertinggal lah tadi, Prof. Yang
Pardon?
example, saya tertinggal example yang mula-mula tadi, the first example. Yang
Ini yang on the
on the note.
Thank you,
okay,
Prof.
I'm going to give you.
How do you get
the note as well?
How do you get 60,000 end of cash inflow at the end of year? 60,000 tu.
Macam mana tadi tu?
Oh, thank you, Nak.
Was it this one?
Yeah, this one. How do you get end of year itu yang 60,000 tu?
15,000 ni.
60,000.
60,000 ni.
Yeah.
End of 1 year, 52,000. End of the year 2, another 11,000.
No, the figure 60,000 dengan
The figure is
15,000.
just an example ni.
Oh, okay. So that's example only lah.
Yeah, because the total return is 75,000. So
right.
Prof split it into 2 years. The first year 12 months will be, I mean each month is 5,000.
Okay. Just total up. So total
Yes.
75,000.
Yeah.
Yes.
Okay. All right. Thanks, Prof.
All right then. Thank you very much.